Today, we're going to talk about bookkeeping. I know this can be a little intimidating, but we have Betsy with us. She's going to walk us through it in a very easy to understand way. So right now, just take a deep breath and relax, and let's dive into it. And today, I want to invite Lori Gates. She is the community banker for Oregon Pacific Bank. It's one of our sponsors. I'm trying to find you here, Lori.
Good morning. Good morning. Yes, I'm Lori Gates. I work for Oregon Pacific Bank. I am the vice president here and the branch manager. And I've worked here for quite a long time, since May of 1980, but I won't go through all that because that's not what we're here about today. So, and thank you, Ani, for inviting me and inviting us, the bank, to do this with you. So today I want to talk to you guys a little bit about, why is the separation between a personal and a business account so important? Even if a majority of you become sole proprietors, you're not an LLC, corporation, partnership, it's important to keep your separate finances from your business finances. Record keeping, so you have a paper trail. You can always download for wherever you bank. A lot of times with the online banking, you can download all your transactions from your bank to QuickBooks, Quicken, spreadsheets that you have at home, to make it easily accessible to a bookkeeper if you have a bookkeeper, or if you do your own books, but you'll keep those separate. If you ever need to reimburse yourself from your business, or let's say you're out and you're purchasing something, forgot your business checkbook or your business debit card, you can always use your personal stuff, but when you get back, reimburse yourself to show that paper trail. Very, very, very important. Whenever you come in to apply for a loan at a bank, and you're sole proprietor, business, etc., they're going to want to see paper trails, basically, so it's not commingled. Very, very, very important. And I know someone on here that I know, Ron Moore. Hi, Ron, you there? Yes. I saw him.
Yep, Lori, I'm here.
I thought so. Ron, I mean, you have a you have a large company that you manage, and do you find that it's very, very important to do that?
Oh yeah, it's absolutely necessary to keep business and personal separate. It's absolutely necessary to, we actually scan and attach every receipt that we do to our entries in QuickBooks. So if we ever need to get to it, we don't have to dig files. We can pull it up just in QuickBooks. Yep. I guess we're a little bit anal that way because I have a pretty good in-house bookkeeper, but yeah, I mean, I say that everything you're saying is really pertinent, especially the bigger that you get. You can manage small stuff pretty easily, but as you grow a business, it's absolutely necessary to have good habits and keep those habits growing. So
thank you for adding that information. Yes, very, very important. Any questions from anyone regarding, the separation of personal and business? Or okay, just remember, you're number one. Take care of yourself and your business. Keep them separate.
Thank you so much, Lori.
But you're so welcome, Ani. Thank you, everyone.
For coming today. We're going to have somebody from the Oregon Pacific Bank team come on each of our meetings, and they're going to be sharing different tips with us about business finances and what you need for a loan, what kind of things they're looking for. So that way we get a little bit more of insider information on this arena. So I really appreciate you taking the time today to do this.
You're very welcome.
And I hope you have a great day. You're welcome to stay around.
Okay, I think I will for a little while. Yeah, thank you.
Thank you. All right, so now let's talk a little bit about raindrops. So you guys, for being participants of this program, have access to professionals. And we currently have people in finances, we have a CPA, we have a business advisor, as well as legal support. And we also have digital marketers available. Although since this program is focused on your business finances, we hope that you would like to work on that. But you guys are welcome. Every time that I share a slide, there are usually a lot of links embedded in them. So if you click over here, you're going to be able to go to the website where you can sign up and select who you would like to work with. We do have a short description of each one of the service providers so that you have an idea. No pressure though either, like just think about what is it that you actually need, what is going to help your business go to the next level, or what is the biggest blockage that you currently have that you need to overcome in order to continue to move forward. So think about that and then go in and read the description of all of those service providers that we have for you. This is a free service for you guys. Thankfully, our funders are allowing us to be able to compensate our service providers, but to be able to offer this for free to you. If you haven't already joined the Facebook group, actually I saw today we are at 70 something. So we're glad that you guys are utilizing that as a resource. This is where we post all of the recordings and all of the files that we share throughout the program. And I also send this on an email. So make sure that you read those emails that I do of a follow-up of each session, because those contain links, all the files, and all the things that, you know, I'm trying to keep you informed. This thing just moved to, oh, I just click on the link for the Facebook group. All right, so now, give me 1 second because this is continuing to move into the link.
While you're working on that, I'll just a couple things. First of all, we realize that some of you are not able to share your video. We're trying to figure that out on our end. We're not actually seeing that on our end, but we're continuing to look at it. And then the last question, how long are we able to use Raindrops as a resource? The program ends, let's say the program ends at the end of September. So you really want to take advantage of that quickly, so you have an opportunity to make a connection and actually, you know, get service within the next month and a half.
All right, thank you. So we are on week number 3 of our program. This is going to be Intro to Bookkeeping. The mentor hour is tomorrow at 9 in the morning. So make sure that you show up for that. These are our speakers. Today, we're going to be talking with Betsy. And these are your cohort leads. Remember that you're automatically assigned to them. And if you end up being like in the air, you're going to stay in the main room with me and Nate. But we do have everybody assigned. If you have any discomfort on your cohorts, please let us know. No judgment, no problem. We just want everybody to be in an environment that is educational, where we can all learn and build up our community. This is a table of all of your mentor hours for the rest of the program. It contains the date, the time, and the link to join as well. You are required to only attend about 3 of these throughout the program. I do recommend that you do as many as you can, because this is the time where you can ask your own questions and get them answered by our expert speakers. So with that, I want to introduce you to Betsy Vega. I have known Betsy for quite a few years already. We worked at the SBDC together. She's the founder of Rose City Balloons, and this is a premier balloon company in the Willamette Valley, where she specializes in balloon sculpture, arches, garlands, and more. She's also the founder of Latino Enterprises, which is a bookkeeping service, business management, and notary. She's been working as a bookkeeper for small business owners for the last 5 years. And she's a former SBDC advisor that taught in Shemekedah Community College, where she was able to help people with responsible managing individuals, with new entrepreneur business owners, classes on CCB. and she has helped many business owners thrive through one-on-one advising. And aside from creating a beautiful decor for grand openings, she is very passionate about helping people and providing guidance for their business success. So with that, I just want to welcome our speaker today, Betsy Vega.
Thank you. Hello, everybody. My name is Betsy Vega, as Ani mentioned. I'm going to see if I can share my screen. I'm not sure how to. Let me see if I got this right. Okay. Then
You got it.
Okay, let's go here, and then it's view, right? Slideshow. Okay, you guys see that?
It's perfect.
Are you? Yeah.
Yes.
Okay, perfect. All righty, let's get started then. So we're gonna talk about today the intro to bookkeeping. And many people can get intimidated by this, or they can say, oh Lord, I don't want to do this. But as part of being a business owner, this is really important to understand, or at least have a notion of what it is. So anyhow, bookkeeping is the data entry, daily administration of your financial transactions. It's the recording. It's like to say, we're going to look at this on a scale and see what we got. So also, bookkeepers can be the ears and the eyes of a company, because if there's some unusual transaction, they can say like, hey, what's going on here, right? But it's also really important for you to understand if there are any discrepancies, to say, hey, this doesn't look right, or I think, or I have a hunch, or something, at least have, that notion that something may not be right. Many bookkeepers also can incorporate payroll into their company. So this is something, service that they can also provide. So when they speak about my bookkeeper, sometimes it's also interpreted like the person who does their payroll as well. So they kind of like intermingle. I just have to say this. I am so thrilled with this program, because I love the way that it builds from the money part of it, because it can be so vulnerable for so many people. And it started out with our first class that we had, which is such an amazing class, which was the psychology of money. And then we moved into budgeting. So now it's almost like we go piggyback each other with a different concept, and it's breaking it down in a really nice way where everyone can understand of what this is. Let me see how, okay, here we go, of what it's about. So what's the difference between bookkeeping versus accounting? So bookkeepers are the ones who prepare the three most important sheets, which is the profit and loss, the balance sheets, and the cash flow. I'm going to touch a little bit more on the profit and loss, and through the course, you'll see more on balance sheets and cash flow and how all that relates together. But at least you have a notion, and we're building up so that you can have more of an understanding on where your books, I'm going to put quote books, are for your financial administration of your company. And so the way I like to see it is like a nurse and a doctor. So bookkeepers are more like the nurses. They prepare the patient for them when the doctor comes in. And that's basically what the accountants do. They interpret that information, which provides more of an insight on your company financials, and also they receive the information that they give from the bookkeepers for the profit and loss, the balance sheets, and all these little numbers go into different categories. So that creates where they do your business or your personal taxes. So all that has a role in playing in that. So today, what we're going to talk a little bit more is about the categories. So every single category has its a utility on where it goes in your tax preparation. So it's really important to keep on what your cost of goods sold, meaning that it's the operations to produce the product. For example, in the construction world, and that's I'm really familiar with that. There's the supplies and material, there's the labor, there's all the tools that they buy, the rentals, etc. So all that is preparing in order to produce a product. Let's say a roofer, which I'm familiar with roofing. So they buy all the material in order for them to create this roof. right? So all that information would go into the cost of goods sold, which is that it's preparing to produce a product. And so that's where we get your net gross income, okay? And so then comes the other part of it that says, okay, now we're going to go with all the general expenses that go. So we have the heart of the expenses, which is the cost of goods sold, is to produce this. And now we're going to go with all the general expenses that can be from anywhere from advertising, legal and professional services, office expenses, utilities, which includes the rent, the electrical bill, and all those other bills that you have in order to run your company, or if you have a facility where you have your office, then all those little details that come in place. And then that gives out to the net operating income. So we have your gross income, and then after all of your expenses and everything else, then we're looking at the bottom portion of it, and that's the net operating income. Okay, so into when we get into the profit and loss, there's a method of accounting. So you have two ways that you're going to tell the IRS how you're going to do this. Either you're going to do cash or accrual. And so cash is really simple. From the first of the year, which is January 1st, all the way to the last day of the year, which is December 31st, you're going to account what that money is going to be for. So whatever income, whatever expensive, that's what accounts for. With accrual, which is a little bit more of the technical on the accounting side of it, is that you're allowed to count for the money that you haven't received. But let's say you invoice somebody, let's say on December 31st, and then you want to account for that money for that year, then you're able to do that, for that 1 year, but then not account it for the following year. Does that make sense? But if you have any questions, we can definitely talk about that. So it kind of gives you a little bit of leeway on that. That's why it's called that accrual. And so also there's the summary of your revenue, what and how your company is doing. So there's also what I mentioned, that income versus expenses. So that's definitely what it is. So it's pretty simple, but sometimes it can be quite a challenge to say, well, how much am I making? How much am I spending? And all the details that go in between. And what it's really important is that when you learn to see where you're spending more money on, and then it's like, hey, I think I spent $10,000 on Facebook this month. I think I need to back up a little bit on that one. And so versus that, maybe people get excited and they said, well, I'm going to help restaurant businesses. So I'm going to go have a meal almost like every day. And that's something that needs to be corrected, because you're not going to spend all your money or your income just going out on restaurants and saying, well, I'm helping people, I'm helping the economy, I'm helping our community because I'm eating out, but that's also affecting your business as well. So those are one of the really biggest things that people like to tend to do. It's either the advertising, because they want to bring it out there, but then there's also a budget that we need to look at, and then also the meals part of it, that they say, oh well, it's a tax deductible, I can deduct it, but it's not quite like that either. And so yes.
What do you recommend for a construction business, accrual or cash accounting?
I would recommend for very small businesses that they're getting started, to start out on the cash. But once they start getting a little bit bigger and they go into more on the commercial side of it, then they can switch to accrual, because there's going to be invoices that are out, but they haven't gotten their money paid. And sometimes they don't get paid within like 60 to 90 days. And so that's when we talk about getting loans and things like that. So it gets a little bit more complicated on that sense. But yeah, they can, when they're first starting out, maybe 1 or 2 employees, I would recommend to stay on the cash to keep it just manageable. And once they get a really good hand of that, and then they get into more on the commercial side of it, then they can move on to the accrual part of it. And then also that goes in, they'll have an in-house accountant by then, or a bookkeeper or somebody, because they'll definitely have a lot of accounting transactions that are going to be taking place too, and plus the HR, and it gets a little bit more complicated on that sense once the company starts growing. So yeah.
All right, thank you.
Oh, you're welcome. So this is a snapshot of what it is on hand to invest, adjust, and reduce, eliminate, like I just mentioned. And so again, this is a great way for day-to-day financial operations. And one of the biggest things that I do once a company starts working with me is adopting new accounting methods. And that means that you're not going to bring your box at the beginning of the year and say, here you go, I'm going to give this box to you and here's my books, you take care of it. I'm like, no, that doesn't work. So we go ahead and we balance everything out, so that way we prepare and let the new client know. It's like, okay, this is what I want you to do. I want you to keep this on a monthly basis because you're the owner of the company and you need to know what's going on with your company. I'm just here to guide you and teach you. But other than that, at the end of the day, when, IRS says we're going to do an audit, God forbid, but it happens. And I've seen people, get into really hot messes. And so, and we're there to help them out as well. But when that happens, it's like, they're going to come to you and your company, not to me. And so that's why it's really important to keep that in mind. Okay, so we're going to move on to the balance sheet, and which is the assets, liabilities, and equity. And so basically just a really short brief of it, the assets is what you own. So it's the equity, it's what the owner, the company owns, versus the liabilities, meaning what you owe. So let's say you purchased a new vehicle, so that would be your assets. And then what you gave for down payment, that would be an equity. But then you have the loan, which would be the liability of it. So that's basically how that plays a role on when you purchase a new vehicle or you purchase a new equipment. So this basically lets the investors know if they want to go ahead and let's say invest in your company, or it also gives an idea of what and how much each shareholder of the company will have, depending on what the company makes. And then they say, okay, well, this is your piece of the pie, or, you get 30% and you get 40% or whatever it is that they want to divide their shares on. So, but we'll look at those on the future weeks that are coming up. Okay, also
we have a question here.
Yes.
So only something with a loan is considered an asset?
Something with a loan? No, I was just giving an example, like when people purchase vehicle, but if you do purchase, like, for example, office furniture, that is an asset for the company as well. Or even your tools, anything that you have that is of a cash value, I would say, then that would be part of your assets. Does that answer your question? Okay.
Well, then there's another question here, and then we can move on. Then what is equity?
Equity is everything that the owner owns. And then again, that what we're going to be talking about more on the next class. That's what they're going to be providing more. So that's why I just wanted to give a brief touch of it, just to say that these are the language that we're going to be getting to know more. But that's just definitely what we'll see on the next week. And so I don't want to jump ahead, but then at the same time, it's just on the briefly, it's what the company owns. That's the equity of it. So even so, like let's say an owner pays themselves for let's say that they need to pay their bills or as a personal form of it. And so then that's the equity that they would give to the company. That means that, that's what they made, and that's what they need to pay themselves. And then it all just rounds out to what the company is about, and the money that comes in and comes out. Does that make sense? And that's where we move here with the cash flow. So where it measures how a company generates its cash to pay for its debts and it funds its daily operations. That's why those are the three components that have. It's the profit and loss, which is what the company makes and expenses. And it has the balance sheet, which that balances out. And then it's the cash flow, where they look at the daily activities, the operating activities, the investing, the financials, and then all of it just comes up to the summary of a snapshot on whether somebody wants to invest, or if bankers want to say, hey, you know what, you can afford a loan, or you can't afford a loan, because there's not enough money to pay for whatever it is that you want to do. But then also there's that opportunity to say, well, that's why I'm getting a loan, or that's why I'm asking for a loan, so I can, be able to manage better, or pick up my revenues, or whatever it is that you need to use the loan for. And for example, here with me, I always try to stay away from the loans, and that's just me on a personal level. So it took me a little bit longer because I saved up more money. And once I came up to what was $12,000, I said, okay, either I can go and purchase a new van, or I want to open a bigger store. So I had to put those in the balance, and I said, okay, well, what do I want to do? And I said, you know what, I'm going to open a retail store, because I know that that will generate more revenue, because I will get known. I have a place where people can come, and then I can purchase a vehicle. So I still drive my car. I still go to U-Haul and rent my trucks, but I'm really happy and proud that I'm a retail owner, that I have a space that I can, that I can have customers come in and buy. So those are the type of decisions that that you can make. But it's just also looking on your budget, looking at your profit and loss, where your expenses, where's your income coming from, and then also to balance, and that's why you have the balance sheet, where it all balances out. Okay, so I'm just going to briefly touch about payroll, which that includes with federal and state. It includes the employee hours, and also the tax deposits. And many questions that business owners ask is that where do they get the money from in order to pay the tax deposits? Well, it comes from what you invoice the company of a service you did, when that money comes in, and then that's when you pay your employees, and you deduct that money from your employees' paycheck. So then you deposit the checks, you deposit that tax deposit into the federal account for your federal obligations, and then also for state, because state wants a piece of the cake too. And so then there are the reports where you have either your quarterly reports, which is a 941, and then for the unemployment is a 940. And then also for smaller businesses, you can do a 944 or a 940, which is a yearly one. But you do have to make this reports. And if you don't trust me, I have people that their accounts have been garnished, and it's not a nice thing. And it's really frustrating for business owners when they do get garnished, because especially here in the state of Oregon, they will garnish your account. And so it's really important to have all of these reports in place, and also pay for those deposits. And what goes also with the payroll is when you do your general liability reports, because they do need to see what the gross income has been for your employees in order for them to give you a rate for your general liability. And the same goes for your workman's comp, depending on what your gross income is for, your gross wages with your employees, that's the rate that you're going to pay. Like, for example, in a safe report, I would say, let's say somebody made $38,000 on their wages for their employees, where depending on what they are going to their services for example, for landscaping, they would probably pay anywhere between $2,000 or $2,500 on their workman's comp report for that yearly rate. And it just depends on what the numbers are of what their rate goes for. So it's really important to keep this information, because that's where you're going to pay your general liability, and you're also going to pay for your workman comps on the yearly basis or on a month-to-month basis, depending on what and how you set that up with your insurance agent. Okay, they have any questions on that?
Oh, there are so many questions. I'm just copying them. I'm waiting to see. So if it's okay, I'll ask one or two, and then we can continue.
Yeah, and then we can go out to the breakout system. The breakout after that one.
All right. So in regards to being an employee or not, what's the difference between an owner taking a salary as an employee or just taking a draw?
Well, it just depends, because if you are an S corp, then the company would pay you, and that's a system of reporting as well for the IRS. But if you are an LLC, let's say sole proprietor, then it's something that you just take owner draws from the company. I'm a sole proprietor, and that's what I do. I'm not an S corp. So what I do is that I myself say, okay, well, I made this much, and so I get to pay myself this much. Or let's say I'm gonna, to me in my mind, sometimes I think I'm like, okay, I don't want to take from the company, but I'm just gonna, quote unquote, borrow $100 from the company. But it's not really like that. But what you do is like you're paying yourself, because eventually the company has to pay you, But sometimes when you have to make these really quirky decisions, I guess I want to say that. But once you do have a system in place, then it's so much better to just make yourself a paycheck like every 2 weeks. Some people do that, or sometimes they get paid every month. So that's why it's important to look at your books, because either you get paid a little bit more, that because your system, your company made more money, so you get to pay yourself a little bit more. Or let's say it wasn't a good month, it wasn't a good sale, so it's like, oh my gosh, I can't make that $1,000 payment, but I can pay myself, let's say $700 per se. But then that also gives an incentive. Well, what is it that I do have to do in order to pick up the revenue in my company? So it's also that balancing, just find balance to see how am I going to, or where is this money going to come from if I'm running this business or I'm running this company. Does that make sense?
Wonderful. All right, let me come here and ask another question. I am seeing your request for a Q&A, so I'm preparing a poll to see what you guys would like to do. Do you have to file these reports that you were mentioning just now if you are a sole proprietor LLC and have no other employees aside yourself?
No, you don't have to do any of the quarterlies, because it only accounts for the employees of the company. So technically you're the owner, you're not an employee, but yes, you are an employee because you are running your company. But that's not the way the IRS looks at it. They look at it like, if you have like paid employees, with their 40-hour a week if they're full-time, or 20-hour a week if they're part-time. So that's what they're really looking for. But if you're a sole proprietor, they don't really look at that. So yeah.
Okay, so let's continue with the presentation. And again, let me do this one, which is like right here. For a sole proprietor in an LLC, is it still an owner's draw when you do that?
Yes, that is. It is an owner's draw. So what I do is that I put it on the balance sheet as a owner's pay. So I have different years for each one. Like for example, there's 2020 owner's pay, 2021 owner's pay, and then for this year I have 2022 the owner's pay, and that keeps everything in order. So that way they know what and how, let's say their income is increasing. Like let's say, I'm just making this number up, but let's say somebody got, they first started their business, and then they're like, oh my, I only made $5,000 in the whole year. It's like, I can't survive with $5,000, but then you're like, hold on a minute, let's just see how, and then you change your methods of operations, you change different things, and then you start seeing that revenue come in. And then when you look at the year in comparison, it's like, wait, last year I made 5,000, and then this year I made 13,000. So you're like, wow, there is a difference in that. And then now you get incentive, and you're like, hey, I'm going to go ahead and move on to making more money, and you get excited about that. So those are the things to keep in mind too. So.
All right, so I am asking here, I just launched a poll to see if you guys would like it. It's a resounding yes. Let's keep the breakout activity and then just do Q&A. There are a lot of questions here. I mean, it's normal. This is a complex subject. So I am okay with that if everybody else on the team is okay with that. And
So
if
I'm
you,
understanding.
Betsy, are okay with that.
So I'm understanding that they want to skip the breakout session. They want to do the oh, okay, so no breakout session. Well, I can incorporate because these questions are going to come in, so that's going to be good. Is that what I'm understanding, right?
Yes, you're understanding correctly. There were
Okay.
a lot of requests for just doing a Q&A, and so I decided to make a poll here, and it does seem
Oh,
like
okay.
it's an overwhelming amount of people that would like their answers, their questions answered. So I think I'm okay with that. And then what we can
Okay.
do is let's do these questions, and if we have those 10 minutes at the end, then we can still do the breakout activity, but let's focus on questions right now.
Okay, that sounds great. We can do maybe how much is the breakout? Like maybe 10 minutes or so? Is that right?
We've been allocating between 15 to 20 minutes lately
Okay.
to them, but yeah, let's just do a Q&A, continue with this, and then we'll play by ear.
Okay, so that's what I was saying, maybe like 7-10 minutes of Q&A, and then we can continue. Does that would that work? Or, because I don't want to go past it with the Q&A, but then I don't, I just want to stay on time.
You're welcome, Betsy, to finish the presentation as I'm writing all of these questions, and then we'll go through them.
Okay, that sounds good. Okay, so then I'll go ahead and wait, and how do I go back? Anyhow, well, I was on that session for a little bit, which is different types of books that there are out there on the techie side. As you can see on the previous slide, there was the QuickBooks, which is a super popular one. There's FreshBooks too, that's popular. Dubsado is becoming popular because it has a CRM with it, is the client management system. And then also there's a famous the Excel, which that one has been for ages, since Excel started, and I really like the simplicity of it. So it's really great for new entrepreneurs to adopt a system that they can look at, they can manage, they can feel, they can touch, rather than having a system like QuickBooks, let's say, that it's all in the computer. Then you have to learn the new system. You have to learn how to manage that. And although many accountants have adopted that, it can get quite complicated to read. And so, but it's important that if you want to invest in your time and company, then, that would definitely be some time and energy that you would have to invest in learning all these other techie forms and some people are savvy, so that doesn't make a difference. But
Betsy, can you return to the slide before where you talk about the bookkeeping systems, please?
I don't know how to do that.
Oh, all right. I can just read it for you guys because I do have it here. It is, and I will write them on the chat as well. QuickBooks, Dubsado, FreshBooks, and Excel.
Yeah, those are just some of them. Let me see if I can. I'm not sure how to do that. How do I go back?
Exit full screen.
Okay, let me see.
Exit full screen and then go back.
There we go. Okay, let me see here. This is the one, let me see, view. There we go. Okay, thank you. Okay, that's the screen that they wanted to look at. And so these are just like some quick popular ones. I know there's so many more out there, so many more systems that have been created. And so whatever it is that you like to use or you're more familiar with using, then, it's something that you want to keep doing as long as it gives you the results on, an accurate profit and loss, an accurate balance sheet, and an accurate cash flow for your company. Are there any other questions?
Oh, there are. So I'm gonna get started. Okay.
Uh-huh.
All right. So this is related to software. So this person gets bogged down on tracking sometimes. Then they're playing catch up at the end of the year, Is Quicking always the bookkeeping software to start since he has a Business Plan Pro? It seems like he has some of those elements in the software, or can Excel be set up so that he can do all of that as well?
It just depends on whatever it is that works for them. I mean, I like Excel because it's so easy to use that you can put in the information yourself. And then also you can upload it to whatever system you're going to use. And that's what I like about the compatibility on both sides, where Excel or even the Google, what is it called? What's the
Google
Google one?
Sheets.
Yeah, Google Sheets. Thank you. You know, those also work very well. But I know that that the Excel is a lot more compatible when you're going to upload into these other systems.
Right. So did you finish with your slides, or would you like to finish with your slides and then continue with the Q&A?
Sure, we can do that. Okay, I think I have 2 more slides. So one of the most important tips, and if you can write this down and keep it for yourself and even adopt, and this is what I tell all of my clients to do, and even on myself, sometimes I get a little slack, but I definitely try to keep the receipts on a monthly basis in separate envelopes. There are some, let me see if I have one here to show you. I have these sleeves, I don't know if you can see that, where I put I have one in my car and I have one here at the office, where when I go and I purchase something, I just go ahead and keep it on the side of the seat. And I don't have to deal with receipts that are all crumbly or they get full of coffee, or I've received, you know, so many receipts even with chocolates on it. And so yeah, I told my clients, please don't give me your receipts with chocolate or you know, coffee stains on it. Just buy one of these. I think they're like $1 at any of the office supply stores. And then if you keep it by the side of your car, all you have to do when you put a purchase, you put it in here. Or if you have like the QuickBooks system, you just take a picture of it, snapshot it, and then for record keeping, you know, just put your receipt in there as well. And so those are the best quick adaptations in order to do with your receipts. Because I used to, many years ago, I worked for a CPA. And I would see that people come in with their boxes and then give the box to the CPA. It's like, here, you do it. And it's just like, no, it doesn't work that way, because that's your business. You need to keep control over that. And so that's why it's really important to, you know, to have more control of your business. And then also it makes you feel empowered. It makes you feel like, okay, I can see that there might be something that we can work on, or, you know, a pat in the back. It's like, hey, you're doing a great job. Keep doing it, whatever it is that, you know, you're working on. So so those are really good things to look at. And also to keep, just to make sure it goes on a monthly basis. The other one is to inform your bookkeeper or your CPA any major purchases, such as equipment, vehicles, office furniture, so we can document those correctly. One of the things that I have found with several of my clients as well is that they purchase a car, and then I'm seeing all these like 490 something, you know, continuously. I'm like, what's this about? Like, I see that there's a recurring monthly, you know, and they're like, oh, I just bought a new vehicle. And I'm like, oh, okay. Well, now we have to put it in each category, and we have to start out from the purchase, so then we can have a balance on how much they're making their monthly payments, how much is going into principal, and how much is going into their interest. And sometimes I tell my client, here, come here, I need to show you something. Did you see how much is going into interest? You have almost $300 going into interest. Did you see how much is going into principal? You have like $100 going into principal. How much and when are you going to finish paying your vehicle? And they're like, oh, I didn't realize that. And I'm like, yeah. I'm like, you're just giving all this money away on interest rather than trying to finish paying off your vehicle, so that way you can save money and you're not just, you know, throwing your money away. So that's why it's really important to, when you do make a major a purchase, to let your bookkeeper know, or even to learn how to read the statements and how much is going into principal and how much is going into interest. So those are really important tips to keep in mind. And then the last one that I want to share is these are really important resources that I give to all my clients as well, is to read about the IRS and starting a business, and also the business expenses, is how to keep a business, because your bookkeeper and your accountant can say many things to you, but then at the end of the day, if you get audited, you're going to say, oh, my bookkeeper told me. But then the IRS is going to say, yeah, and what did the book say? So I get accused, I'm going to say, but I'm proud of it, is that I'm too much by the books, and I don't care. I'm like, yeah, I'm by the books, because if you ever get audited, I mean, like, that's what they're going to look at. They're not going to, you know, talk to your CPA, or they're not going to talk to the bookkeeper. They're going to say, this is your business. Show me what you got. You know, where did you get this info? Oh, who told you that you can do that? Right? So that's why it's really important, when you had your leisure time, if you can really take a look at these and understand it more, then you'll understand, you know, how to keep and stay in business. Because again, like I mentioned to the group before we started, was, you know, Al Capone, and this is one of the things I really get a kick out of it, is that Al Capone did not get caught by all the crimes that he did, but it was by tax evasion. So I'll leave it at that. And that's my presentation, so we can move on with all the questions and answers that I can provide.
All right. Thank you so much, Betsy. Do you think you can stop sharing your screen so we can actually see you?
Yes. Let me
All right.
do this.
So
there you go.
All right. So we have quite a few questions here. Since we were just talking about receipts, there are a few questions about receipts. So I'm going to ask them all at the same time, and then you can reply, because there are a few of these questions are the same question, just expressed differently. How long should you save your physical or digital receipts for? Can they be tossed away after a year? And then the other questions about receipts is that if they are being saved digitally on QuickBooks or in any other platforms, why is it still important to keep them?
Very good questions. Yes. So the IRS recommends for 7 years to keep your records. And the other part of it is that should anything happen to those systems, you know, God forbid, the modem falls or something happens to it, and you have all this in digital, how can you say, no, but I did buy that, you know, I do have the receipt. I know I have it. So where is it? So that's why, if anything, I think I would say for safety purposes, for your business, it's always great to save your receipts. I have manila, not the manila envelopes, but the other brown envelopes that I keep, and I put them in a rubber band. You know, I just put them all together, rubber band them, and then just put them in a plastic tote, and then just put those away in my garage. And that's basically how I have my my receipts. And then I, you know, tend to say, okay, you know, through the year, it's like, okay, can I, you know, toss this out or not? And then you can also look at that. So, but that's basically what the IRS recommends. So.
All right. Now, so there is this is a QuickBooks related question. There is a function to scan the receipts to each charge. If they do so, do they still need to keep all the receipts?
Well, that's up to a personal level. I mean, again, like I did mention in the answer previously, is that if anything happens to the system for whatever reason, and that in which it happens, you know, and you can't find that receipt, then if you do have a paper trail of it, then you can, you know, again, upload it and then keep that. So it just depends. I mean, if it would be a great practice that I would recommend. But if you don't want to keep them, then, you know, you don't have to, because supposedly they're in a safe place. But I don't trust it sometimes. You know, technology can do so many things. So, but it just all depends on that personal level. So.
Okay, very good. How much is considered a major purchase?
A major purchase can be anywhere from $500 or more. And so even like with the contractors, what they do is they'll buy compressors. I don't put those as an asset because I know that at the end of the year, they're going to buy another compressor because they use it so much. But some depends. Some people put it as an asset, but again, I just put it as supplies and material, or like a tool equipment that they purchase because I know that they're going to use that. It's like a hammer. Sometimes, you know, it's going to last quite some time, and it may not. So it just depends too.
Would you say that if it's something that is going to last for more than a year, then you can say it's an asset? If it's going to last less than a year, it's a supply that you're using?
Yeah, like for example, I have air compressors that I do for my balloons. And I put it as an asset, even though it was $300, because I know that it will last me quite some time. And so it's an asset to the company.
Okay, excellent. So let's see.
You just really want
Are contracts, in example, money that hasn't been paid yet but will be paid, considered equity?
No, that's different from the balance sheet. So that's more on the profit and loss. That's more on the income side of it.
So if I could jump in there, that's a great question. If you have received money or you have something that's going to be paid out, let's imagine you get a pre-purchase, and so you've got this cash that's sitting in there as an asset. You would think that that would be reflected as equity, but on your balance sheet, there should be a liability called, and I'm going to ask Wendy or Betsy to tell me what this should be. It's deferred revenue, or yeah, I think it's deferred revenue that actually shows as a liability, because that money is going to have to be spent to create the thing that you're going to be sending. So you don't get it counted as equity until the transaction's complete.
Mm-hmm. That's correct.
Okay. Is a couple a sole proprietor in the case of owning an LLC?
No, that would you can do both. Either it can be a joint venture, but it's more considered as a partnership. And I don't recommend for husbands and wives to be part of it, because you pay double taxes when you do your taxes. You pay the company taxes, and then you're going to pay your individual taxes. And so I have had couples in the construction business that because one gets the license and the other one doesn't, then they have to be together in that sense. But if they can remove, I have removed couples from businesses because of that same purpose of tax, the tax purposes. They just pay more taxes when they're married and they have the both LLC.
All right, and either way,
somebody said truth. I got hammered last year. I saw that.
If you do choose to be in a partnership, in a business partnership with your life partner, do have a written agreement of how that partnership is going to work, because things can get messy. And if they do, it's better to resolve it before they get messy, you know, because we are in a different state of mind. So just keep that in mind and make sure that if you are doing business together, you have agreements in place, who's responsible for what, who's doing what, and how you're going to deal with a situation in which, let's say, the two of you have a different opinion on a very major decision of your business. How are you going to solve that? Are you going to bring a third party to help you do that? So just things to keep in mind there. All right, so there are very funny comments over here on
I know, I saw that. I had a fire.
All right, so is there a standard template somewhere that has all of the things to keep your records on an Excel sheet or in a Google sheet?
Yes, if you go to the IRS and go to the starting your business, they have the different categories you can get started. or also, oh, I just lost my train of thought here. Oh, there you go, on the Schedule C. So if you Google a Schedule C, that's going to give you the categories that you can put on your Excel. And some categories you do use, and some categories you just don't, because that's not part of, you know, something that you do in your business. So it's important to look at those. Either my first go-to would be the Schedule C, to see the categories, and then to start a business that also has the categories and information for you.
All right. Another question. For a small business, a sole proprietor LLC with a small budget and little financial experience, do you recommend going to a bookkeeper or an accountant or another professional to get better set up to make sure we're doing things properly? She's appreciating this information, but it's overwhelming. And they really want to make sure that they're doing the right things. Before you answer, I do want to point out that that's part of what Raindrops can help you with. If you want to make sure that things are in order, that they make sense, to set it up and to set you up for success. Wendy is a CPA, although she doesn't give tax advice. She can really guide you in setting things up properly. And Misty, you know, can help you with those things as well. So they're both mentors of this program, but they're also on Raindrops. And if we have a little time here, or if it's okay with you guys, if you want to just do a small 30-second pitch of the services that you can provide, or if you want to just write it on the chat, you guys can start coordinating that. So Betsy, you can answer the question now.
Yeah, definitely meet with a mentor. I did. Like I mentioned to the group earlier, is that I started out with $100 for my balloon business. And from there, it was starting to invest and keep. And sometimes there were times when it's just like, I don't know if I can make this, because, you know, I had an out of pocket to pay for certain things. And then when I was able to look at my books and sit with an advisor myself, then it was like, oh, okay, this makes sense. And although I have extensive knowledge in a lot of things, you know, it's like a doctor, you don't operate on yourself. That's why you go to another doctor to operate. And that's how I view it. That's why it's really important, because it can be so vulnerable. You know, money and finances can be such an vulnerable situation, that when you do bring in a professional to guide you, to teach you, to show you, it just brings down so much ease, and you have so much peace of mind to say, okay, either I'm doing the right thing or I need to correct something. And sometimes we don't like to be corrected, but it's really important to say, you know what, I guess I need to make this change in order for my business to start thriving.
Okay, thank you. Thank you for that. It's good to recognize when you need to reach out. You don't have to do everything yourself, even if you're a solopreneur. This question, I love this question. And you guys are welcome to pitch in, especially those of you that work in finances. How can you make bookkeeping, accounting, finances more fun? They find it a drag and avoid it.
Okay, I'll have somebody else help me out on that. Let's see what they got.
So I'll jump in. When I was a banker, I came to realize, it was this huge light bulb moment. I came to realize that financial statements are written in a language. Accounting, bookkeeping is a language written in numbers. And I put this in the chat, but for those of you who didn't catch it, it's not only empowering, but it can be exhilarating to sit down with financial statements and be able to see the story of the business in front of you. And I certainly, as a brand new business owner, it's way too much to ask for you to jump in, and you know that shouldn't be the first thing you learn. But as you are evolving as a business owner and manager, learning to read that language, and you don't have to be expert at it, but just to be able to view your financial statements and see the story is really valuable. And I highly recommend that. So when it becomes a story, it becomes much more interesting. It becomes, you know, you're participating in something. You're not just putting numbers on a piece of paper.
And for me, I just wanted to say how I make it fun. It's I make a date. I make a date for like 2 hours, and I get all of my receipts on a weekly basis on a Monday, which is the best for me. And sometimes I don't have that Monday, but then I'll move it on to the next Monday, and that gives me a tone of how I'm going to be managing my week. I sit down with just a small receipt in small batches, and then that's much more easier to manage than try to manage the whole yearly, or you're coming in with boxes, because then the mountain is just way too big, and that's when it becomes overwhelming. But if you can adopt at least maybe an hour to your business just on the accounting part of it, trust me, you got to trust me on this. It's the best time you're going to invest in your company, because you're setting that time on the administrative side. And even the first hour it is to meet with a mentor, or to even read a book on it, or even look at these IRS resources that I provided, I think that's the best way to start on your moving forward with making it I guess more attractive, because what it is that you don't know what you don't know. And I don't know what I don't know, so where do I even start? But with the examples that I did provide, and also Robert mentioned, those are really great ways that you can get more a grip of your company, because it's like learning a whole new language. You know, you have to, like they ask, well, what is liability? What's equity? What's an asset? So once you learn that, then that makes a lot more sense, because again, if you are going to go to a banker, and I'm sure the bankers who are in this group can attest to that, they're going to see, let me see your P&L. That's what they ask for. Let me see your balance sheet. Let me see what you got, so we can see if you do qualify for that loan.
Okay, another question here. And this is related to S Corps, and there have been quite a few comments over here. So this is their first year as an that the LLC is being taxed as an S Corp, and they're doing quarterly payroll taxes replace the quarterly estimated tax payments she made as a sole proprietor. So is that correct?
Right. So once they start, no, there's a difference on that. So I'm going to let Lori is a CPA, right?
Wendy.
I'm going to let Wendy answer that, because she's has more of that experience than I do.
Okay. Yeah, an S Corp is an election that you can make to be treated in a certain way for tax purposes. So an LLC can make an S Corp election, or a partnership can make an S Corp election, and it has to do with how you're treated for tax purposes. Whether an S Corp is a good thing for you or not is something you should probably discuss with your CPA. An S Corp is a fairly complicated sort of animal for tax purposes, and it can be appropriate, especially for businesses that are especially profitable. If your business is making significantly more profit than, say, your reasonable salary might be for your position, then it might be beneficial for you to be an S Corp. The purpose of it is usually to reduce self-employment taxes. So if you're just starting out and your profits are small, you're probably, an S Corp may not be necessary for you at this point. But as your company grows and your profits grow, you may want to talk with your accountant, your CPA, about making an S Corp election. With an S Corp, you'll pay yourself a salary on a payroll check and file payroll tax returns related to that salary, but you still are taxed on the entire profit of the company above and beyond your salary. It's just the taxes can be reduced. So again, it's a little bit complicated for this session, I think. Bottom line is, if you're really small, you're not making a significant profit, an S Corp election may not be appropriate for you yet. but this is something that you wouldn't want to handle yourself. You'd want to work with a CPA on making that election.
Thank you.
All right. Thank you. Okay. On the subject of partnerships, do you have to file a partnership return if married or qualified joint venture, married and did not file the partnership return? Are they in trouble or deep underwater?
Yeah, I think these are going into the CPA questions, which are not related to the bookkeeping, because it's more to the accountant questions. Again, those are something that they would speak to their CPA about, how they're going to file their taxes, because it can get on the personal level, especially for a married couple. It can go into double dipping on not double dipping, but paying double for your taxes. So,
all right. So this person understands that it's important to pay yourself, but in that vein, what about the business paying a rent for the space it takes in your house? Is dedicated shop space, in their case, not a bedroom office, a good idea to be using to be doing the deduction for the home office?
I see that some people have done that, but also what I have known is that IRS will want pictures of where your office is at if they are in an audit, because definitely cannot have a bed in your office space, in your bedroom. It has to be a real office. And so there is some percentage of deductions that you can do if you have a quote unquote home office, because that doesn't mean also you'll have your office in the living room or on the kitchen table. It has to be a designated space in order for you to have that percentage deducted. And also, let's say the internet, the light bill, things that a business would utilize to run a business from your home. Also, the big thing is that they said, oh, I'm going to purchase meals for my home office. You can't do that. So it has to be, let's say an establishment to, let's say you're going to water or snacks or something like that for your employees, but you're not buying snacks and water and buying chicken for yourself. So yeah.
Make sure that everything is business related and not, even if it's your personal business, it still needs to be a business situation. Now I'm gonna ask these questions for nonprofits. Are P&L categories the same for a nonprofit as it is for a for-profit business?
There's a huge similarity for that. But when they do their taxes, then that's where the different categories are being utilized. But pretty much it's the same.
Okay. How do you manage your credit cards with your banking? So, for example, you purchase something with a credit card, but you don't pay it, but you don't pay it off. You only do a payment, and how do you manage that? Like, or I think this person is a little confused on the question. In this case, what's the best way to manage your credit card purchases for your business?
Again, you treat it like a separate from your business. You treat it separate from your personal. If you're going to get a credit card that's going to be for your business, just use that for the business. But don't mix them together. I've also had situations where clients mix them together, and I don't want to know how many red box movies you rented. I just need to know how much you paid for your Home Depot per se. There's also people who have Home Depot cards that incorporate with the QuickBooks, and so we keep information on, like they download the same way as QuickBooks does, and so we can keep that account. So that's why it's really important not to mix your personal with your business. Again, that is just across the board with credit cards as well.
And when they are paying interest on the credit card, there is a portion on expenses when you can do interest payments. Is that only for big loans, or can that also be done with credit cards?
That depends on how they want to put that for the interest paid, or they just want to do the whole amount to say this is what their purchases. But I wouldn't go there, because then you're paying a major in again, it's a loss for the company, because you're paying so much interest of it. For, let's say, on the expense of it, you're going to put those, oh, it's interest. But then again, I wouldn't try to go there. I would just try to pay as fast as I can, as much as I can, to that purchase, to that credit, rather than continue to accumulate all this interest of it.
All right. And then let's see. I think we're pretty much done. Is it still square footage based, the part for the home office, in terms of the percentage that you write off?
Yes, it's the percentage from the square footage of they take the whole square footage of the home, and then the square footage of where that office is, and then you pay a percentage off that. Is that correct, Wendy? Yeah, that again goes into the tax purposes. So
should they be
Sorry, I
saving-
confess I was reading the chat and I didn't fully get what you were talking about.
Oh, the question was about the percentage and the square footage on the home. So I answered that it would be they get the whole square footage of the home, and then they get the square footage of the office space, and then you pay a percentage of that.
Right. Generally, you can use a ratio, square footage of the office divided by square footage of the total home, assuming you qualify for the deduction. Mm-hmm. Which, again, there's quite a few rules, and you need to make sure you understand what those rules are.
All right. It looks like we're going to have like an open Q&A with the CPA, aka Wendy, because there are a lot of questions that are definitely related to that. I want to show you something for next week and for tomorrow's mentor hour, and then we can continue this conversation. So give me a second here. It's just very quick and simple, and I think you're gonna like this. All right, so next week we have Ellen Dean coming in. If you guys have been on Rainmaker, you know how great she is as far as business management, and she just has a plethora of knowledge that is amazing. This is a bit of a different kind of session. In this, we do more of a Q&A session, and you know, we pick her brain. She has been sharing her income statements publicly. So I think that that's quite interesting to be that open on finances. So just keep in mind that she's going to be sharing her personal experience with her statements and her finances. So if you guys have any questions that you would like to have answered and you would like to send them ahead of time, you're welcome to email me about that. And then remember that Betsy's Mentor Hour is tomorrow, Thursday, August 11 at 9 a.m. Is that the actual? Yes, it is the correct date. Just making sure. And that's it. I just wanted to keep that in your radar so you guys know what to expect next week. Let's see if we have anything else here. The Mentor Hour is essentially this. It's a Q&A session. It's informal. You guys just come in. Anything that wasn't clear to you today, then you can clarify it tomorrow. And then that way we just get a little bit more of time with our expert speakers. We are not going to have a Mentor Hour next week. But so just keep that in mind. Then let's see. Can you tell a little bit about the difference between inventory and assets?
The inventory and the assets, that they go hand in hand together, because let me close that. I was on the I was trying to catch up on all the chats, but yes, that definitely goes on the balance sheet, and that's part of the assets, because you do have that in your company. And so when at the end of the year, you have to say, well, I have this much money accumulated in my store because I have the shelves full of this inventory. Whether, let's say, if you were to sell them, then that is money that's coming into the company. So yes, definitely that goes into the assets.
Should a sole proprietor dealing with health services pay quarterly federal tax and IRS as well?
If they have employees, yes, they definitely do pay those. But that would again be another question for a CPA. There's a lot of CPA questions. Yeah.
I see a few questions here, still some confusion on inventory versus cost of goods sold. So essentially, every time you sell something, that is the cost of goods sold. However much that costs you, that's what you put on the cost of goods sold. But it might not be your entire inventory, because you're probably just going to be selling one product rather than all of them. It will be awesome if you can sell all your inventory at once. But usually you just do that as you sell it. So you have a record of your inventory, everything that you have, and then as you are selling that kind of has to match, right? Whatever is coming out, then it comes out from your inventory count, and then that becomes cost of goods sold.
That's correct. Like, for example, with me and my balloon business, I import my balloons from Italy, and I have my walls full of 100% biodegradable balloons. What happens is that if I get hired by these corporations or somebody who wants to do a birthday party for their children, then I have to pull that inventory in order for me to produce the product that I'm going to sell. But let's say that product, I didn't use it, then that stays as an inventory, and that stays as an asset to my company because it's not used. But then, so that's where the transfer comes in. And it's really important to keep what you have on hand, what you sold, and what is used for the company in order to produce a product that you're going to sell. I know it can be like a tongue twister, but that's why it's really important to keep all these different categories and keep a really tight of what comes in and what comes out from your company. And that's why the psychology of money is a huge part of it. Because if you don't have a good relationship with it, then it's like, okay, I don't want to spend, but I don't want to give, but I don't want to do this, but then you have to. And so that's where, there's that, that tug and pull with the money and running a business.
And on that line of inventory, is that recorded as the cost to manufacture or as the value for which you sell it?
I may not understand the question.
I think I do. So usually with your inventory is what it costs, not what you're going to sell it for. And actually, if you so if you have to do a claim for your, I don't know, let's say somebody stole something. If you have to do a claim on the insurance, they take into account is what it costs you, not what you are going to be selling it for. So that way they avoid people stealing from themselves so they can get reimbursed for the entire revenue that it will bring.
Yes, that's okay. I understand now. So if I sell retail, somebody comes in my store and buys a product, I'm going to sell it for retail. But if I create the product to sold, then I'm going to sell the whole product, but I'm not going to sell the bag as retail, but I'm going to use it at the cost of my cost, which is the wholesale cost. Yet the product, I'm going to include all the the labor. I'm going to include my employees, the delivery, the setup, and everything else that goes with it. So
yeah, so it's the exact cost of it, and you have to keep into account. Like I do include packaging, all of those things, because it's very specific to a product. It's not related to everything else in the business, so that's how you look at it a bit more individualized.
Yeah.
Could
Yes,
I jump
Robert.
in real quick?
Absolutely.
Absolutely.
So there's been a question that we haven't hit on yet, the idea of startup expenses. And I just want to make really clear that we understand this well. So it was just so you can, as you're creating your business, before you actually have revenue, as you're creating your business, you might be, because you don't have a business yet, you might be paying out of your personal accounts to do things, and you can package up those expenses as, I think we refer to them as startup expenses, and it sits
Yes.
as an expense that gets it can be depreciated. We don't need to go into that, but you can basically get that money back over time. The question was just asked, well, how far can you go back if you have a hobby and then you turn that into a business? I'm afraid that's not how it works. Once you actually have revenue, it's a business. So even if you were running it as a hobby, you can't go back and just say, okay, now this is a real business and I'm going to capture these expenses in the past because I've started accounting for it differently. Unfortunately, you can't do that. The startup expenses, as I understand it, and feel free to correct me if I'm wrong, really are pre-revenue expenses. And once you have revenue, whether it's a hobby or a business, then that's sort of where the clock starts. Am I wrong in that? Am I correct in that?
Can I clarify my question a little bit, Robert?
Yeah, absolutely.
So in my case, I'm a board game designer. I haven't sold any board games yet,
Okay.
but I've put a lot of money into buying prototypes, buying prototyping equipment and bits and things like that. I haven't sold anything yet, but over the last year or so, I've bought things like a printer. I've spent maybe $500-600 on getting set up, but I'm not actually a business yet.
Okay.
Can I put that as startup expenses?
Absolutely. Absolutely.
As
I don't
your
know if
asset,
there's I
yeah.
don't know how far back you can go, but at least a year. I don't know that there's a limit on that.
Yeah, I think it's within the year again, and I guess Wendy can help us with that too. As far as I know, it is within that year that you can put it in as an asset. So I can answer because before I started my business, I bought compressors, I bought different items that I needed in order for me to do my business, and so those were set up as my asset because I was acquiring them. However, once I made more than $400, then that's when I had to tell the IRS. It's like, you know what, I made $400 and this is part of my business, whether it's a hobby or whatever it is that you're selling, then that's what the IRS requires. That once you made that $400, they said, okay, you have to let us know, and then from there your business can continue to grow. And then also it runs into registering your business, and it goes into all that legal part of it of having a business in the state of Oregon. So yeah.
Robert, can I ask a follow-up quick question? Yeah.
Yes.
I think my question is, when you say having a business, that means the definition saying, hey, this is the day you incorporated the business, and that's your stake in the ground. And anything before that, 1 year before, whether it's prototypes, this or that, can be considered expensive. But some require even longer period from that. So as long as I have a detailed project notebook that says this is what I'm investigating, maybe last 2-3 years, because some might be a lot more complicated, but as long as I'm keeping a diary that this is heading towards, but I don't have an official business name incorporated with Oregon, or even for that, I should go ahead and establish a business and then without revenue, keep on exploring the idea.
Yeah, I think again, I don't actually know if there is a look back, a time frame where there's a cutoff. So what you say sounds perfectly appropriate. I do know that there's on the other side, there are a lot of hobbyists who generate revenue, and we won't say whether or not they're accounting for it in their taxes, but they're generating revenue over time. And that's where it gets a little bit more sticky, I think, is when you've got somebody who's generating revenue And then at some point they decide, okay, let's actually call this a business now and move forward. I think that muddies the water on the startup expenses thing. But what you're saying sounds perfectly appropriate.
Yeah, and I'm not generating any business. What I'm doing is intense amount of preparatory work, and what I call making alpha units and beta units. But I still have not a single dollar coming back. But I have 2-3 years of very meticulous notebook that says I'm working towards that objective.
Right. So this is Wendy. I think the bottom line is here, if you are exploring a business and you haven't started earning revenue, keep track of all the expenses you're incurring. In the tax law, there are several categories. There are startup expenses. There's another category called investigatory expenses. And the rules about when you can deduct those expenses are sort of data, fact specific. I'm not aware of a 1-year cutoff in the rules. So I think, again, the main point for you to remember is track those expenses, keep close notes about what they were for, when you incurred them, who you paid, keep the receipts. And then when your business has actually started, and again, it's kind of a gray area. It could be when you organize your LLC. It could be when you earn your first revenue. You and your CPA will have to decide what the date you started business is. Again, it's a facts and circumstances determination specific to your business. So there's not a one size fits all answer. And unfortunately, that's true for a lot of these tax questions that I'm hearing. They're specific to your business. And so I'm happy to talk with you individually about any of those. I can provide general tax information about kind of what this landscape of the rules looks like. But it's really important that you find a tax advisor who can really sit with you and understand the totality of your situation, including your business and your other sources of income. For example, if you're married, if you own a home, they really need to look at everything all together in order to determine the answers to these kinds of questions for you specifically. So again, I encourage all of you to find a good tax advisor. Unfortunately, I know they're not free, but I can give you, as part of the free Raindrops program, some generic, what are the general rules? And then it's kind of up to you and your personal advisor to apply them appropriately to your own situation.
Okay, thank you, Robert and Wendy.
Thank you, Wendy.
And also, I just wanted to add, and if all else fails and you need to go back, you can always amend your taxes, and then you can always fix that should that be the situation. But you definitely need to speak to your tax advisor for that.
And guys, like when you have any doubts, I have called the IRS before to ask questions just to clarify it. You can do that, and it's all right. Like, yes, they're busy, blah blah blah, but it also gives you a peace of mind that it was the IRS that actually answered that, and they are the ones that are enforcing all of these tax rules. So if you have a doubt, if it's not clear yet, reach out and see if they reply, and if they don't, then try again. It is 10:31, so for those of you that need to log off, you are welcome to log off. I'm gonna stay here for a little bit. I don't know if Betsy can stay for a little longer. If you cannot, it's all good. And I want to thank everybody for connecting today. Your questions have been awesome. So thank you so much for being so engaged in the process of knowing your business finances. And thank you, Betsy, for sharing your knowledge with us and being here today.